Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday ETF report of May 16th, 2026. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us look at the QQQs over the past 6 months, and we're going to zoom in on this, and we want to show you this indicator up here, short-term indicator, is a sell signal, but we had something like that before, not as clear as this, and the market went up at that point. So we have to be very wary of these signals right now. But what we're looking at is the reversion to the mean, and this green line is the 20-day moving average, and that would be a reversion to that particular average in there when we call it reversion to the mean. But down here, when we look at this intermediate term indicator, we definitely see a downturn. Now, I'm recording this about midday on Friday, so anything can happen over the next 2 or 3 hours. So we take this with a grain of salt, but we are very much overbought. And let us look at the QQQs year to date, and it is up 15.6%. So the QQQ is the NASDAQ 100, up 15.6%. Last week we were up 14.3%. So even though the market is down significantly as I'm recording this, we are still up, which is a good sign. But again, this is what's bothering us over here. We just may get a little reversion to the mean, and there's the mean again, that 20-day moving average. And let's look at the S&P 500, which we'll also look at in our Saturday stock market recap, and we can see the same thing going on. Not a clear downward signal up here, which is different than the QQQs, but still we want to see that reversion to the mean. When we look down here, we see almost a crossover to the downside, and I guess we're going to have to wait till Monday and Tuesday to see exactly what happens. And of course, we're going to get a lot of news on the U.S. dignitary visit to the Chinese government and what they come back with. We're hearing certain things going on right now, but I'm sure over the weekend we're going to get a lot of news on that. And that might have something to do with, let's take some money off the table, and I'm talking about the market in general, or let's stay in. But this is bothering us a little bit in here for a short-term downturn, because the market is pretty strong, except for Friday. And let us look at the past week, and look what's back up and top again. And this was at the bottom last week. We're looking at energy and we're looking at oil and gas. But all of a sudden, with the oil price shooting up this morning, and I'm talking about Friday morning, yeah, these two ETFs went right back to the top, from the bottom to the top. Absolutely amazing. But let us look at the technology, up only 1/3 of a point. This week, S&P up about 1/3 of a point, and the NASDAQ 100 actually down. Those are the QQQs, actually down for the week. And this is as of Thursday's close, because for the whole week that we're interested in, Monday through Friday, it's actually up a point. So it depends on your timing, on when you put these numbers in or when I get the numbers on the charts. But it's close. It's very, very approximate. But what I want to show you down here is the ARK Innovation ETF down 4.43% this week alone. Home builders down 5%. The home construction down 6%. This is all in 1 week, folks. And when I say 1 week, it's from really Thursday to Thursday. And year to date, yep, there's a semiconductor up there. Can you believe this return so far this year? 69%. Absolutely unbelievable. Oil and gas have been taken over. Oil and gas and energy have been leading these ETFs year to date all year long, except for last week. And of course, this week, the semiconductors have been not so good. But for the year, over the past month or so, past 2 months, actually, these things have just been rocking and rolling. Technology up 22%, really, really doing well in here. And of course, the S&P 500 was up 8.4% when I took this shot and got these results. And again, home builders down here. Healthcare, of course, can't get out of its own way this entire year. Financials have been doing terrible all year. And all of a sudden, the retail ETF has not been doing so well. And home construction, look at this. Home construction down almost 10% for year to date. That's not very, very good. Home builders, down 5%. Now, the home builders and home construction have a lot of stocks that intermingle with each other. In other words, there's stocks that are in both of these ETFs. So we make one top stock portfolio out of both of these, and you're going to see that in a second. In fact, you're going to see it right now. But let's see. So we take the whole theory of clean surplus investing is to, if you have an ETF or an index, and it's each ETF, each index is going to have the above average stock in that index, or the above average stocks and below average stocks in that ETF. So we use clean surplus to pick the above average stocks, and those are our portfolios. So the semiconductor is up 69%. Our semiconductor portfolio is up 42% for the year. This is not very often that you see us underperform a corresponding ETF. Let's look at technology. Technology is up 22% for the year, where our top stock portfolio is up 32, almost 33% for the year. So that's doing very, very well. We do have a NASDAQ 100 top stock portfolio, which between this year and last year has been performing about the same as the QQQs. And we just haven't used that very much because we use the technology up here, and we use the XSD, which is the semiconductor ETF, up here. So we would rather use stocks from these two portfolios rather than the top stocks from the NASDAQ 100. But usually before the last year and this year, we've really outperformed the NASDAQ 100 in a big sort of way. So as long as we're close to that, we're good, because usually we do outperform. Let's look at the S&P 500 and our growth portfolio. So the S&P is up 8.4%, and our growth portfolio is up almost double that. And the growth portfolio, most of the stocks come out of the S&P 500 and a few out of the NASDAQ. Well, a lot of stocks, the big growth stocks, are on the NASDAQ, and we do have some of those in here. So S&P 500 up 8.4%, our growth portfolio up 15.6%. Now, the ARK Innovation, we use our technology top stocks in the technology ETF as a comparable against the ARK Innovation. And remember, this is Kathy Woods, and she has a lot of ARK portfolios. And this is the Innovation ETF, which has a lot of the stocks that we know and that are in that portfolio. But we're up 32% while she's down 1.7%. And this is year to date. So we're doing very, very well. She has a lot of smaller stocks in there that we don't touch because we want to see stocks that have a long operating history. And some of the stocks that she has are just beginning their move up or move into bankruptcy or move into just being mediocre companies. So she has more of a gamble. It's a riskier portfolio than our tech portfolio, but you can see how much we outperform using something like our top stocks in the technology sector. Then the home builders, again, now we take stocks from the home builders and stocks from the home construction, and we make one home construction portfolio, and that is up 8.5%, almost 8.6%, while the home builders are down 5% and home construction is down 9% year to date. So our portfolio, and you see it also here, up 8.5%, almost 8.6%. So we're pretty happy about that for for portfolios that we thought might do better this year because of lowering interest rates. But the way inflation is going right now, these stocks are getting hurt, but our portfolios are still very, very positive. In fact, they are up more than the S&P 500. So that's a nice portfolio to have. And then we have a dividend growth and income portfolio that's up 9.75% when you include the dividends so far this year. So 9.75%. And this is one of the portfolios that we talk about as you start approaching, you're getting toward retirement, 50 years old, 45 years old. You want to start growing a portfolio like this, because with the dividends that this creates, that will help you as you get older. Because as you get older, if the market has a big break and takes 2 to 3 years to recover, you don't want to have to sell those growth stocks, because you're always going to need growth stocks. If you get to 60 years old, odds are you're going to get into your 90s. That's what I read all the time. That's what everybody reads all the time. So the older you get, the more of a chance you have to live into your 90s, which is pretty decent. So you have to have growth to protect you against inflation, because in 20 years, inflation can double or cut in half your spending power. So you've got to have some stocks that are in the growth category, but you also need income coming in to augment your pension plans, if you have any, from when you worked. And several of you, or many of you, may have several pension plan money coming in, plus your Social Security, plus a portfolio like this gets you about, we look for 3.5 to 3.85% of income per year from a dividend growth and income portfolio. So you take your growth portfolio right here, you take your dividend growth and income portfolio, and you add some T-bills, only 3-year T-bills. You don't want to be affected by interest rates. You add some T-bills in case you do need extra money, something happens. Because if you have that extra money in T-bills and something happens, it's not a disaster. It's just an inconvenience. And I love that term, because you have the money that in the T-bills, which are cash, which are also generating about 3.5% right now. So you have those T-bills you can cash in, and it doesn't become the problem doesn't become a disaster. It's just a mere inconvenience. So you can see that just about all our portfolios are, all our portfolios are outperforming the S&P 500 without a doubt, and some are really outperforming the S&P 500, like our semiconductor ETF, and just about all of them are outperforming their corresponding ETFs. So these are our portfolios, and if you subscribe to our ETFs, you will get the ETF portfolios, which are come out of the XSD, which is a semiconductor ETF, and come out of the technology ETF, which is the XLK. So you get those portfolios, and a lot of you take those portfolios and you mix them in with your growth portfolio, and I get calls, at least one call a week, saying you made me wealthy over all these years, because we do have people following us well over 15 years. So there you have it, folks. Our portfolios are doing very, very well this year, and this market rally that we've had for a good part of the beginning of this year has been doing very, very well. But again, the S&P is up 8.4%, while our growth portfolio is almost doubling that, and some of our other portfolios are tripling, quadrupling that. And the 5 years returns, this was as of about 3 weeks ago now. The ARK that I talked about, the Innovation Fund, down 30% over 5 years. The S&P is up 82%. The Tech ETF, which is the XLK, up 132%, but our top stocks in the XLK that we take out of the XLK, up 285%, up double the ETF itself. So that's how, by picking the above average stocks, you can outperform any ETF, or just about any ETF, over the long term. So, folks, we had a very, very good week right up until Friday when the market decided, okay, it's time to correct a little bit in here. We just got overbought, and some of those semiconductor stocks went straight up, like NVIDIA for the past 4 days, or the first 4 days of this week did very, very well. And so people are taking some money, some profits off the table. But we had a good week. Our portfolios are up higher this week than they were last week. You go out, take your mind off the market, be with your loved ones, go for a walk on the beach or on the golf course or whatever. Most of all, stay well, stay healthy, and folks, we'll see you right back here in a couple of days with our daily newsletters.